There's got to be a better way to do it, right? There's got to be a better way to buy stocks and not wait a year just to break even. That's not only a waste of capital, it's a waste of time, and it's not a very smart investment. So what most professionals do, and now a lot of the times this type of a strategy that I'm going to introduce you to is not particularly, I mean, it's not a real big secret or anything, but the actual strategy that I'm going to teach you in initiating positions is rather different than what maybe anyone else I have ever heard talk about. There's a lot of guys who have, I mean, if you work for a large corporation, especially, I'm talking specifically about a public traded corporation. You may have a lot of stock options, or you may have stock that was given to you as part of your retirement program or an incentive program of some sort. I can imagine that companies like Enron and WorldCom years ago that were high flyers that were trading, for lots of money, and a lot of the people who worked for Enron and WorldCom had maybe even their life savings into the stocks at those times. Well, if you have stock in a publicly traded company because you work there, and it was given to you as an incentive, or is it given to you as bonuses or something like that, if you're holding that stock and it comprises the majority of your retirement or wealth in that company, let's think about some other companies recently that have really hit on some hard time. Let's take Lehman, for example. Just imagine working at Lehman Brothers and, having the stock up here at $85. Now, I bet a lot of the senior executives at Lehman and a lot of middle management even had a number of opportunities to purchase shares of the stock at different times at pretty reasonable prices, and maybe they were even bonused stock, back when it was down around $27, $25. It hit $85, and what's it selling for now? $23. If you were working for Lehman Brothers at the time, and you saw the stock up around $85, and you did absolutely nothing to protect your investment, you would have seen it cut by 2/3 today. That's a pretty tough way to wake up in the morning to see that your stock is down another almost $7. It's a very, very, very tough thing to see. Yesterday it was trading at 35. Now it's trading at 23. That's a $12 decline in the stock. So, that is that's pretty rough. That's very rough. Well, maybe it was last week. It was 35, but now it's at 23, and things get pretty bad very quickly with stocks. Now, I've told you, and I mentioned throughout this course, that it's very, 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 very difficult to predict stocks. There are probably 1% of the entire population in the world that can actually predict with any degree of accuracy the future value of a stock. There's got to be a better way, and there is a better way. Let's go back to Starbucks here for a second. I would imagine that even the people at Starbucks have stock. They have either incentivized stock, or they had some, a share purchase plan or something, some other benefit that they had that allowed them to purchase stock over time. Now, people bought it back at $12, just thinking, well, it's still $18. Hey, it's not too bad because they're still up $6. Well, that was 5 years ago. And, if I bought stock at $12 and 5 years later it's only $18, that's not a particularly good rate of return. When it was up around 40, what were they thinking? Oh, yeah, this thing's going to go to 100. They're thinking their stock is going to continue up. But the fact is, we can't predict the future. We can't predict what stocks are going to do. The only thing we can do is manage risk. And we can benefit and profit from the management of risk. The most common form of managing risk is simply to use options to protect your stocks. So in other words, let's say we go into Starbucks right now, and let's say we wanted to purchase 1,000 shares. Well, if we took a look at 1,000 shares of Starbucks right now, it's trading at $18, it would cost us approximately $18,000. Not including commissions. Our commissions would be about $15, and with the shares trading at $18.01, it would cost us $18,000 or $9,000 in margin in order to purchase 1,000 shares of the stock. Well, what does that do for us? Let's go to our analysis tab here for a second, and let's take a look at exactly what this would do for us. Well, if we had 1,000 shares of Starbucks, immediately you can begin to see, and let me just set these up. If it goes up $2, you made $2,000. If it goes up $5, you made $5,000. You make $1,000 for every dollar that the stock goes up. On the other hand, if the stock drops to $16, which is $2 lower, you lose $2,000. If it drops $5, you lose $5,000. Now that's not a particularly attractive scenario. Let's go back to our trade tab for a second. The Thinkorswim platform allows you to actually do something quite interesting. There's a couple different number of trades that you can select when you right click on any of the option symbols. Now the most common way that you would be able to protect your stock holding is to simply buy a put in order to protect your holdings. But there's a variety of different put options in order to protect your stock investment. How do you know which one to select? Well, the analysis tab actually helps us to do that quite efficiently. However, there's a couple of different reasons why you don't want to rely on the analysis tool alone, and also you want to use some common sense. And there's a couple of strategies I'm going to describe that allow you, in the purpose of the selection process and the goal of the selection process, is to actually get the stock to prove itself before you make a large investment, before you either continue with the investment or to protect your initial investment when you set it up. And let me explain what I mean by that. Okay, on the surface, you may believe that with the stock selling at $18 and you were to purchase 1,000 shares of that stock, you would want to buy a put. Now, a put would allow you to profit from the stock if it declines. So, placing a put on a stock that you own is probably a fairly good investment. Let's just take a look at a second. We already have in our Analyze tab, we have 1,000 shares of Starbucks at $18.01. Let's go back to our Trade tab and select the 17.5 strike price put. If we wanted to buy a put on Starbucks in order to profit when it goes down, we would select that. Now, one contract of the July 08 17.5 puts would cost us approximately $60, which is, if the price of the put is 60 cents times one contract times 100 shares of stock, because each contract represents 100 shares of stock. If we confirm and send that, we'll see that it costs us $60. In order to protect all 1,000 shares of our stock, then, we need to select 10 contracts. 10 contracts at 60 cents will be $600. And that would be the cost of the investment in order to protect our 1,000 shares. Let's analyze this and see what it does to our profit graph. You could say, well, why would you spend $600 to protect your shares? Doesn't it limit your upside potential? It does a little bit.